Welcome to the daily update, where I'll go over the action in the market from Monday, June 16th, and we'll see how things look for Tuesday, June 17th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, had an up day. We pretty much set the high right after the open and then spent the rest of the day drifting lower. And we kind of just shifted back into the upper end of the range that we were in before Friday. We had the decline on Friday. It was probably a bit of a relief. I'm not sure a relief over what, because a lot of things happened over the weekend, but at least the U.S. isn't officially at war right now, but there's the escalation between Israel and Iran, which may go on for some time. And of course, there's a lot of misinformation about what's going on there and a lot of differences of opinion. You had the big anniversary of the U.S. Army, which happened to fall on Trump's birthday, and the No Kings things. And I thought No Kings actually comes on July 4th. That's really what Independence Day is, because we declared independence. We didn't want kings. So I'm not. Anyway, it's just one of these pop things that happen. And so you have the markets a little bit on edge before we went into the weekend. There was some hedging. There's still some hedging going on. But with the upward move, we really haven't changed all that much. We're still positive in the short, intermediate, and long term. We're above the moving averages. We're not trending. And we have probably the biggest economic report of the week coming out in Tuesday's session, which will be retail sales. Now, I always watch for this, and then sometimes the reaction is rather muted. But with all of the economic concerns going on, are we slowing down? Are we doing okay? There'll probably be some additional eyes on what's happening with retail sales. Okay, so right at the open, the futures were strong. We were up about 0.5% way before the market opened. Europe ended up bouncing back. That carried over into the U.S. session, giving us a gap higher open. We got back above 6,000, and we got up above R1 at 6,014. We didn't quite get up to R2 at 6,052, just a little bit under that, and that set the intraday high. Then we spent the rest of the day just kind of drifting lower. There was really no conviction. We just kind of faded from the high that was set and saw more selling than buying. That's why prices drifted lower. But we were able to close above the 6,030 level. It seems like 6,050 is kind of a pretty critical. It's a round number. It's not like 61,000 or 6,100 or 6,000, but we've dealt with this area before at 6050, and so we'll be watching that on a more closer basis. And we were up 0.94%, giving back not a lot, but a fair amount of the gains that we're seeing earlier in the day. Still below average with volume, and that's probably going to continue now that we're getting into the summertime, and that's typically when we see volume dropping off. As I said, we are still positive in the short, intermediate, and long term because we're above the 20, 50, and 200 period moving average, but we're not trending right now. Keeping an eye on interest rates. Now, the Fed is going to come out on Wednesday. They really haven't been playing a major role these days as far as what's happening. A lot of it's geopolitical. A lot of it's with the trade wars and the tariffs, and that the tariffs have stepped back just a little bit. Now it's like, okay, what's going on with all these trade deals? What's going on with Iran and Israel? And of course, in the background also is Russia, Ukraine, which could come back to the forefront at any time. All right, so some comments. The Israel-Iran conflict remains relatively contained, according to this. Looking at different sources, it tells you, it gives you a different slant, and there is some misinformation. Can have to dig a little deeper to find out what's really going on there. And as far as the market is concerned, the market, of course, is concerned about an escalation that may involve U.S. being in that whole thing as well. But right now, we're mainly watching it for oil. And oil dropped back a little bit. To this point, there's been no real disruption with the supply lines there. And then reports suggest that Iran is working diplomatic channels to try to negotiate a ceasefire with Israel. Well, they had a chance to meet. There was a 60-day window there where they could sit down and talk to the U.S., and they were supposed to meet on Sunday, the 15th, but then they canceled that. And now they're trying to come back and talk again. So we'll have to see how all that works out. I understand that President Trump is at the G7 and he decided to leave early. And he's made some pretty strong statements, like he does pretty much every day. And so he's going to meet with the folks that are helping to advise him, and we'll see how they are going. But the last thing that I saw is, okay, Iran may want to talk, but Israel's like, we have no interest in talking to you. You had that window of time and you didn't do anything about this agreement. So for Israel's sake, we need to do what we need to do to protect ourselves. And we're not interested in talking right now. All right. So as far as the market is concerned, growth had a good day. A lot of the weakness that we saw in Friday's session came back as strength in the session on Monday, with the growth doing well and semiconductors. And that's a big leading part of the market. If we're going to stay positive, we want semis to do well. We want tech to do well, but we want semis to do even better. And that's typically when the market is stronger. Oil is still in the 70s, but it did fall down to 71.83. The VIX is back below 20, so that's positive. Or it had been above 20 after Friday's session. We're at 19.11 there. And a few things back on our short-term extreme list showing better short-term momentum, but not a really long list. We have not the Stochk RSI. It's not on here, but the Williams percent R is. The Stochk RSI was actually extreme negative after Friday, and now it's drifting back more up into the midpoint. We don't have the CCI 14 chart. That's a little shorter term, but we do have the CCI 20. The stochastics, which, because there are three charts on different time frames, they seem to be there pretty much every day. And now the slope oscillator, the short-term oscillator, is starting to turn back up. It's crossing above its moving average, but it's already extreme positive. And then we are getting far away again from the 20-period moving average, which is where we were after Thursday's close. Now we're back there again. And then looking at the intermediate term, still, we're drifting lower to sideways with our momentum oscillators, but the PMO is still extreme positive. And we're still extreme positive, but looking a little more negative, drifting a little bit there with the bullish percent indexes, both for the S&P and the NASDAQ 100. And we're also back to being far away from the 50-period moving average as measured by the boom indicator. No real change to the overall scenario with the Fed. They're kind of quiet right now, but they'll be at the forefront come 2 p.m. Eastern time on Wednesday. Now, it's pretty much as certain as you can get that they're not going to change rates. What's going to be the real news is what's the statement? What's the report that they come out with? What's going to happen at the press conference? Is Jerome Powell going to say something that either gives the market some confidence or causes some fear? So that's what we're really focusing on for Wednesday. And the dollar was actually down here. I think that was a mistake. And interest rates were back up. We're at 4.42% with the 10-year yield. We're still under that 4.5% level. So we want to keep an eye on that. That's when stocks have recently, anyway, started to fall into problems when we get above 4.5% with the 10-year yield. We're still positive as far as sentiment. We did tick up a couple of notches with the update. We're at 62. We've been kind of meandering around this positive area for the last number of days, where after Friday we were down to 60. And we're still not trending. We're below 20. We're below the moving average, but we are positive with the green line above the red line. With the update, the bias is positive, and for the last number of days, I've been keeping the momentum at mixed because there's not an awful lot of conviction, and we're still below average with volume, and so we're not seeing a lot of follow through, especially later in the day. We saw that last week, and we saw that in Monday's session, where the smart money, they're probably coming in and doing things, but they're not really driving things either higher or lower. They did a little bit more on Friday when they were doing some selling, but we didn't really see that in Monday's session. So we just had the Empire State Manufacturing Survey. That is about New York, and it came in weaker than expected at a minus 16. They thought it would be down 6.6. Last time it was down 9.2. So we've been getting some negative readings as far as this is concerned. And this is actually starting to drop lower, where we had a real negative reading in March, and then it was at least improving a little bit, but now it's starting to trail off again as far as the manufacturing in New York. Okay, then equity positioning is still considered underweight. When it gets back up to zero, that's when it's considered equal. But it is improving. But you still have a lot of folks that are really nervous about what's going on one hand, and so they're apprehensive. We're below average with volume, not trending right now, and so they're not really willing to deploy a lot of capital. But then on the other hand, you've got every time we see any kind of weakness or any positive type of bias going on, you've got the buy the dippers flying in. And so there's kind of this back and forth, and that ends up producing more of a choppy environment like we've been seeing. Okay, then announced buybacks. Again, there's the amount that they're considering to buy back, and then the 3 month sum, and it's was really high here earlier on back in May. It is dropping off, but this is still positive, and that's considered a positive thing when companies want to buy back their own stock. We seem to get this a lot these days. These are the forward-looking PE ratios for the various indexes. The one that I focus on over the weekend in the intermarket analysis video, where we were just under 22 in the latest reading. This one has us at 22. They might be rounding this up here. When we get above that 20 level, that's considered to be expensive. Then we also have the NASDAQ 100. That's growth, and that's the most expensive. And again, this is a contradiction of the other chart that I show over the weekend. I have the Russell 2000, or I look at the S&P 600 small cap index. It's down around 14, 15, where this one has us up at 24. So that's quite a difference between the two. So if you did look at this, you would go, oh my goodness, small caps are considered to be expensive according to this particular reading. The equal weight is down more fairly priced. It's above the 15 level, but it's below the 20 level. And then you have the mid caps, which have also been struggling in 2025. They're closer to being fairly priced as well. And then equity flow funds have recently been weak. We're getting to the point where we might start seeing money actually coming out of the market. Instead of rotating around different parts of the market, we're actually seeing this turning negative. And I have another chart to show you later that's kind of confirming that same thing. Gold flirts with record highs here, and gold's been holding up. It's the best performing asset in 2025. And with all this unstable geopolitical, all these things going on, and then the domestic issues with the riots and the protests and the divisiveness that U.S. culture has become. Yeah, okay, people are going to flock to gold. It's tangible. It's real. If you own it outright, not just through the ETF or something like that. Okay, then 1 year inflation expectations retreat from 40-year high. Okay, it's coming down now. Folks aren't feeling that there's going to be as much inflation as they were fearing before. Equity ownership across wealth distribution. Again, you still have a lot of people still own stocks. Then it breaks it down here into the more middle area. And then you have the bottom 50%, according to this chart, of households. They don't own as much stocks. But the top 1% that do own stocks, they own most of the stocks. Okay, this is one of the other ones. Just looking at the employment situation report, workers adjustment and retraining notifications, that has the kind of ominous acronym of WARN. It's like, okay, your job may be going away. We might have to retrain you to do something else. And this is really starting to go up. And then we also compare that to the JOLTS job openings that we got a couple of weeks ago. And then last week, global gold ETF saw the largest weekly net inflow. So again, a lot more money is starting to fly into gold, and a lot of money is also going back into crypto. You've got Bitcoin, you've got all the different cryptos that are happening right here. People are putting money back into this. So that we're seeing a bit of a shift. And then this chart is showing equity flows actually possibly turning negative. We're seeing money coming out of stocks, going over into gold, going over into crypto, and then of course a lot of money will just stay in money market funds, just more like cash right now. So we are seeing a general shift that way. And then breadth thrust, this is just showing how we had that nice little upward move and how that tends to be positive after that. But we might go through a bit of a bumpy time before we get to the more upward side of this, according to this chart. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, so here is the chart. We did gap higher. We got all the way up to R2. We didn't surpass last week's high, at least yet. That's where we topped out, and we hit a pivot point to the upside that I'll point out on the daily chart here. Didn't quite get up to R2 and then just drifted down. There was a little bit of gyration here, but we just kind of went down a little bit. We got down to 6,025. Did see a little bit of buying going into the close. Then we are dropping off. We were down about 0.5% with the futures right before I started recording. We were down about 1/3%. So looking a little bit more negative in the initial overnight session. Still looking good here on the intraday growth to value chart. The blue line is still above the red line and still holding up okay with the S&P growth to value ratio. We're not really falling off here. We're just kind of topping out and going sideways. So growth was up more than value. Where growth was down on Friday, it kind of gained a lot of that back in Monday's session. It was up more for the mid caps, but up less for the small caps. So our end of day small cap growth to value chart is still looking pretty good here, as is the mid cap growth to value and the S&P growth to value with the recent golden cross with this ratio. Still holding up fairly well with the growth to value ratio here, and saw a little bit of a tick up off of its 200-day moving average when we look at the equal weight version of discretionary versus staples. And here's where we're not trending. In the short term, we're still drifting now with the ADX. The green line's on top, so that's why we're positive, but we're below the moving average and we're below 20. That's why we're not trending. Seeing a very similar picture here with the intermediate term. Green line above the red line, that's positive, but we're just continuing to go down. And you have an up day, then a down day, and then who knows what Tuesday's going to be, and if there's any reaction to retail sales. If we have a down day, I mean, this thing is just continuing to show more weakness as far as the strength of any trend. And we're still looking okay, though, with the pattern on the chart, though. We for the most part, as I pointed out over the weekend, we have a series of higher highs and higher lows. That's good. And now we're kind of treading sideways. Now, I did point out over the weekend that this is looking a little bit vulnerable, where we hit some resistance and started to come down. But that was pretty much negated, at least for right now, in Monday's session because we gapped up and ended up having a higher day. This would be a little bit more scary looking if we saw a continued trailing down of price here, but that didn't happen, at least yet. We are still below average with volume that way, and I guess I don't have the other chart. And then we have the weekly sentiment gauge here. We're still up now. They have it red. I see it as positive because when we're in the 25 to 75 range, we tend to go with that. We're not contrarians at that point. It's just when we get up into the dark red area or the dark green area, that's when we start to look for signs of doing things the opposite way of how most people are feeling. And also improving a little bit with this Goldman Sachs sentiment indicator, but it's still below zero. Folks are a little more pessimistic according to this one. We are back below 20 with the VIX, so that's more positive. And coming down a little bit with the VIX of the VIX. As the VIX went up, the VIX of the VIX tends to go down. We ticked up with this fear gauge, went down with the other fear gauge. So not confirmation there, seeing different signals as far as fear. And we're still going up here with the risk on to risk off ratio. This is positive. And this just, when this is going up, that means the market is typically going up and people are willing to assume more risk. And we're still tending to go up here with the high beta. These are the really big stocks, the Apple, Google, Nvidia, stocks like that. When this ratio is going up, and this is part of the background scenario that I talked about starting a week ago, where it looks like the really big stocks, the growth stocks, are coming back in and taking a leadership role. Now, if they can really catch some fire and show some consistency, that could really help break us out of this non-trending environment. But we're seeing improvement and this is still holding up. And so under the surface, it's looking good. We're just not really seeing it yet confirmed with conviction with the overall index for the S&P. And we did see a real move up here with the daily put call chart and a lot of hedging going on right now. Those folks that they may have sold on Friday just to be out over the weekend, the folks that did stay in, they probably hedged. Well, after Monday, they're continuing with more hedging. So we're going back up with the 5-day chart and we're going down just a little bit here with the 10-day chart. This is kind of that choppiness that we've been in lately. And we are seeing an increase in the volatility risk premium. So there is some fear coming back into the market here. The advanced decline line still holding up. Not really seeing any major weakness, not breaking out to new highs yet, but above the advancing moving averages. We're still above zero with the advanced decline oscillator, and we're back above zero with the short-term advanced decline ratio, where we had gone slightly below zero after Friday. And we did see more new highs and a few new lows here, but we're still going down with the 5-day chart and drifting lower with the 10-day moving average chart. And not quite positive here with smart money indicator number one. Now, you are positive if you just look at the indicator itself and its relation to the moving average, and the moving average is going up. That's positive, and some of you might use it in a bigger picture context. But then the boom indicator tries to look at the shorter term moves between the indicator itself and the moving average, and we did turn back up, but we haven't crossed back above the moving average yet. We are declining with smart money indicator number two, Chaikin money flow, and we continue to decline with the Chaikin oscillator. We had an up day, but yet the smart money indicators are actually turning more negative, and that's a bit of a concern. We came down a little bit with the vortex. Now, what was interesting is after Friday, the vortex, the green line went up, and then we have an up day on Monday, and the green line's coming down. Okay, so some weakness is being picked up by some of our charts. Now, this could be overridden, and we didn't have major economic reports on Monday. We do have some big ones coming out on Tuesday, and we have the Fed. The market's going to be closed on Thursday, and so there could be some kind of maneuvering going on that right now is looking a little bit more negative, but it could easily switch back to positive if we get some conviction. And we are dropping back further below this green line with the 10-day average of the highs and lows for the S&P. We had gone above the green line, and that was showing longer-term solid momentum. Now it's starting to drift back down. We're still above the moving averages with all of the advanced decline lines that we study for the different indexes. And we're back above 50 with those stocks in the S&P above their 20-period moving average. We have been looking good. The intermediate term trend is still looking pretty good. And as I go through a few charts, you'll see what I mean by that. But this is holding up better. And we ticked up and we're above 50 with the 100-period moving average study and the 200-period moving average study, where we had slightly dropped below 50 after Friday. And this is the overhead resistance that I've been talking about. This is a pivot point. And we hit that last Wednesday, and that was the high, and we have not been able to get back to that point, at least yet. And we'll see. If we can break above this, of course, that would be more positive. And we continue to be below average with volume. So we're back above 50 with the 20-period, 50-period, and 200-period moving averages on the S&P itself. And after being extreme negative after Friday with the Stochk RSI, we are starting to bounce up there. We're still looking like positive momentum when we look at the Williams percent R, and this is shorter term. The CCI 14, we're not back up and looking extreme there, but we are just barely above 100 with the CCI 20. And then this is a longer term one, and it didn't fall as much as the CCI 14. That's why it got back up there a little bit faster. And we are extreme in the short-term stochastic, declining and flattening out here in the intermediate short term, rolling over below the moving average, but still extreme positive with the long short-term stochastic. Still looking positive with the force index. This is the short-term trend where we're kind of bumping around here with the double and triple exponential moving averages based on 20 periods. And we want to get back above the lines. That's when these lines go up. We're still, for the most part, the last few days, we've been hanging out below these lines. And if we stay down here, that's going to roll the lines over a little bit more. We're still in the +2 channel with the standard deviations chart. We decline, but we're above zero with the balance of power. And another thing, the vortex declined with buying. The balance of power here is declining on an up day. And we did get a little bit above the short-term moving average based on 10 periods. This is a simple moving average. We closed a little bit down below that after Friday. We were able to get back above that after Monday. And we are still more neutral now with the go, no go. It's turned to the lighter shade of blue. We're not too far off of the highest high value here, but we are below the blue line here. Still positive with the Landry Light trending system, as is the proper order. Those still show the trend is positive. The TTM squeeze is improving. We turned a little bit negative after Friday with the darker shade of blue. Now it's going up and turning back to a lighter shade of blue. So that's looking a little better there. And we're still not very far above the zero level with the ease of movement. That kind of fits into this not trending environment that we're dealing with. We did decline a little bit with the Arun after being extreme positive, but we're still positive since we're above zero. And it showed some improvement with the S&P McClellan oscillator, but we're still below zero. So it's still negative when we look at the summation index. We're declining based on price, and we're slightly declining here based on volume. And we improved with the NYSE McClellan oscillator, but still below zero. So now we're still it's really hard to see. The summation index for the NYSE based on price and volume are starting to tick down. And this kind of just popped up. It flew out of here. This is a rate of change going back 50 periods, and we're looking extreme positive here. And look, you can see at other times when we had extreme readings, we might see a bit of a dip, but it doesn't necessarily mean we're going to stop and go the other way. But this just shows that it's starting to calculate this big move up. Some of the higher values have fallen off. Some of the lower values have come into the calculation, and that really pushed up this indicator. And we're still declining with an up day with the swollen trading oscillator based on price and volume. Rolling over, but not quite below the moving average with the PMO, but we're above this red line. That's why we're extreme. We're declining based on price, and we rolled over a little bit. Again, with an up day, we did go down with this indicator based on volume. So we ticked up, but we're still below 50 with the PMOs that are rising. The buy signals continue to decline, and we're still drifting kind of sideways here with the PMOs that are above zero. We're still neutral with the Elder's Impulse system for the S&P, positive with the parabolic SAR, turning back up and crossing above the moving average with the slope oscillator, but we're already above this green line, so we're extreme positive there. But the MACD continues to drift. It's going down. It's actually looking more negative. So we're going up with the short-term slope oscillator, starting to roll over a little bit, but right on top of the moving average with the TSI. Then intermediate term, we're drifting with the MACD and the PPO, where we're going sideways and possibly starting to drift down below the moving average with the PMO. Longer term, this is a bit of a concern. We're still extreme positive with the TRIX and KST, and now these are starting to drift lower as well. Improving, but not above the moving average with the Copic curve. So for right now, that's still negative. We're positive, though, with the Sean trend meter. We're still in the green area. We're still above 50 with the money flow and the ultimate oscillator. Still positive with unbalanced volume. Still above 50 with the RSI 14 and the RSI 9, short and intermediate term. And the intermediate term trend, now we did close down below that, and that was a little bit of a warning I wanted to point out over the weekend. We're trying to get back above this line, and we haven't been down below this red line very much, enough to have it start rolling over, at least yet. If we start to come down from here, that might show some more vulnerability to the intermediate term trend. Staying back above this would help the intermediate term trend stay stronger. Still above all the plotted moving averages, and we're getting far away from the 20-period moving average and the 50-period moving average as measured by the boom indicator, and just chopping around with the bullish percent index, still a little bit below its moving average. declining a little bit with the NYSE bullish percent index and drifting lower, but still extreme positive with the NASDAQ 100 bullish percent index. And just looking how the week's starting out, we're looking pretty good from a chart pattern on the daily side. We're also looking pretty good here on the weekly side. We need to set a new high for this to continue. That would really help things. But for right now, the longer term is still looking pretty good. We're You see how we were negative? Now we're back to positive here with the Heiken Ashi. And we're positive and pointing up with the Kigi chart. We're positive with the Renko chart, but we're looking more negative with the three-line break. So that's part of the mix-up, the lack of trending that we're seeing right now. Still above the midpoint with the 150 and 200 period moving averages, so the longer term is holding up. This is the same, hasn't changed for a long time. Still negative with the mid caps and small caps in the long term. And bonds are positive in the short term based on price. Commodities are positive in the short and intermediate term. Some of that may have to do with oil and gold because they are commodities. Still negative across the board with the dollar. And we saw the growth areas doing better. Communication had a good day. Now we like that, but we need to see more follow through. And tech had a good day. Discretionary had a good day. These are the three big growth areas, and we like that. But can they carry through to Tuesday? Can they show some consistency here? And then more of the defensive areas. We did have staples up a little bit, but energy, healthcare, and utilities, they ended up being down. And we see Canada setting another new all-time high. The S&P did get above 6,000, and then we had the NASDAQ going above 19.6, went down to 19.5, but then back up to 19.7. This is a little bit of a concern, and it happened in the afternoon. Communications had a BPI cross below 80. Now, 80 above 80, that's positive, but having it cross down below 80, that could mean that this particular sector's overextended. And a lot of green here, especially with tech, discretionary, communication, and more of the defensive areas ended up showing a lot of red in Monday's session. And we're right on the 200-day moving average with the Dow. All right, and we've gone from negative back to neutral with the diamonds, with the Elder's Impulse system. Still looking okay here with the NASDAQ. And we've gone from neutral to positive with the NASDAQ. NASDAQ 100 still holding up fairly well. And we've gone from neutral to positive with the QQQs, with the Elder's Impulse system. But the momentum for the NASDAQ 100 continues to drift lower. It just is not showing a lot of strength right now. And we saw a bounce from the small caps, but we're kind of right back up into areas that we've been a number of times before. And we did bounce up here. Now, last week, when we came up to the 200-day moving average with the small caps, that's where they hit resistance and started to go down. So we'll see if that continues, or can we finally break above the 200-day moving average? We are above 50 with the RSI, but we're looking negative with the MACD that measures momentum. And we've gone from negative to neutral with the small caps. Mid caps just continue to chop sideways, and they've gone from negative to positive with the mid caps. Still above the 200-day moving average with the Wilshire 5000 and the total U.S. stock ETF. Financial sector, and as I've been pointing out, this is probably one of the better looking uptrends that stayed better intact when you look at the moving averages. We haven't crossed over to a downtrend, at least yet. But what's a concern is that we're coming right down to the 200-day moving average with the ratio between the financial sector and the S&P. Now, we are bouncing up from that, and that could be positive if we continue to go back up. But this is something that we were watching as we were drifting lower here, and possibly there's some support that is coming into this ratio. FANG index, all-time high. These are the big stocks, setting a recent golden cross here. This is the stronger looking part of the market currently. So Apple was up 1%, and we had Amazon up 1.89% above both moving averages, starting to generate a golden cross here with Meta. It was up 2.9%. Microsoft's been doing really well since they came out with their earnings. Golden cross, setting a new all-time high. Google above both of the moving averages, up 1.2%. NVIDIA above both moving averages, 1.92% advance there. Tesla was up over 1% above both of the moving averages. Netflix, not back to an all-time high yet, but up a little bit over 1%. This ratio between staples, which is defensive, and tech, which is growth, that continues to decline. And that's positive if this keeps going down. And still seeing more of a drop off in the short term correlation between US and world stocks, where the longer term correlation continues to get stronger. Oil was up into the mid 70s. Now it's dropping down into the low 70s. The dollar continues to be in a downtrend. And the semi to tech ratio did bounce back up. Now, this is pretty choppy here, but we have been improving with the semi to tech ratio. We want this to keep going up if we're going to be more positive. And retail, I wanted to show this because retail sales are coming out. Now, when you compare the retail sector to the S&P, it's been underperforming now going back to 2021. But when you look at the retail by itself, we're still above the 200-day moving average. We are in a downtrend, but the RSI came down to 50 and right now is bouncing up off of that. So we are seeing a bit of an improvement there. We'll see if we can get any more follow through on Tuesday. And the Truflation reading is still coming in above the 2% level, or the latest reading that we had from CPI was at 2.4%. We're still below 4.5% with the 10-year yield, and that's more positive if we can stay down below that. And we're hanging out around the 50-day moving average with the 10-year based on price. Still looking okay with the Q to S&P ratio. Not as strong here with discretionary to the S&P. We're still looking pretty good when we compare large cap growth to value. So we're coming slightly back above the moving average here with the large caps. Still looking okay with the mid caps. I'm still bouncing off of the moving average with the small caps. The S&P to utilities ratio, that's holding up for right now. When this is going up, that means the S&P is outperforming utilities. And this is another ratio, the staples to S&P ratio. When this is going down, that is more positive. That means the S&P is outperforming. So what's the outlook then for Tuesday? No change here. Positive in the short, intermediate, and long term, but we're not trending. And probably the biggest economic report day of the week, we're going to get import-export prices just to keep an eye on what's going on there. Retail sales will be the big report. And then industrial production as well as capacity utilization will be coming out, and business inventories. And then we'll get the excuse me, the NAHB housing market index. And then geopolitical, that's kind of at the forefront right now, specifically Israel, Iran, and what's going to happen with that. And it's a very fluid situation right now, and it seems to be changing quite often. Okay, here is the economic calendar for the week here, where we're going to get the Fed coming out on Wednesday. The market is going to be closed on Thursday, so I'm not sure when initial jobless claims are going to come out there. And we'll get the LEI as well as the Philadelphia Fed index on Friday. Here's also a look at this, and see, even on this calendar, it's closed, but they still have jobless claims coming out. So maybe we'll still get that, but the market's not going to have a chance to react to that if it's closed. Okay, seasonally, looking at June 17th, neutral to positive across the board. We are now coming into options expiration week. We're up 55% of the time, down 45% of the time. So a bit of a lean in the positive direction. But be aware, the week after options expiration, these statistics flip-flop and we look more negative than we do positive. And we do see a little bit of negative seasonality here during post-election years. That's the green dashed line. Then we're going to be closed on Thursday. And then we do drift a little bit and see a little bit of a bounce going into the end of June. All right, so we still are looking at our smart money indicators being more negative. Now, the accumulation distribution, the bigger picture, is it's still positive. When I say negative, it's because of the boom indicator, but we are negative with the Chaikin money flow and the Chaikin oscillator. The discretionary to staples ratio, that we're bouncing off the 200-day moving average there, but we're still in a downtrend. And we're negative with the S&P and NYSE McClellan oscillators and summation indexes. The copy curve could be getting ready to cross above its red line there, but it hasn't yet. And the swirling trading oscillator, on an up day, it's still declined. And then the longer term special K chart that I show in the deep dive video over the weekend, as well as the momentum for the NASDAQ 100. On the positive side, we did see a recent golden cross with the growth to value ratio for the S&P. The bullish percent indexes, they're just chopping around right now, but we're negative because we're below the moving average, but they're still giving us quite high readings. And the parabolic SAR, as well as, and I probably could switch this over to the negative side here because the oscillators are just kind of floating now. Where the ease of movement, money flow, ultimate oscillator, vortex, those are still positive. And the financial sector, when you look at it by itself, it's positive. It's when we do a ratio with the S&P, that's where we're a little bit concerned and just watching to see how that plays out. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Here are the pivot points, which have already been updated on the YouTube community tab. So our conclusion, no changes here. Positive across all time frames, but we're not trending right now. Thank you. Have a really good day on Tuesday, and I will talk to you in the next video.